What's going on, everybody? So as we approach the end of the tax year, I thought right now would be a great time to put out a video on some things you should be thinking about as we get into the end of the tax year, some tax planning moves, and then also some changes to the tax code. So the ideal audience for this is if you're a current client, if you are a brand new client, and if you're just somebody out there who has a vested interest in maximizing their tax position as a day trader or an investor. This video is for you. Let's get it. What's going on, everybody? Brian Rivera, CPA, and I wanted to welcome you back to the channel. On this channel, I typically talk about personal finance, entrepreneurship, investing, taxes, all that good stuff. So if this is your first time here, don't forget to hit that subscribe button. All right, guys, so first order of business is going to be estimated income tax payments or catch-up payments, right? So basically, estimated income tax payments are for anybody who generates a tax liability greater than $1,000. Uncle Sam is going to require you to pay that ratably over the next 4 quarters in the following tax year. So if we did your taxes, or if another tax preparer or CPA did it, they should have given you estimated income tax vouchers. And in that situation, you would then use that schedule to keep you honest. Now, if you are a trader, this becomes very difficult, right? Because your profit and loss fluctuates throughout the quarter, right? It's a roller coaster, right? Q1 can be hot, Q2 you're flat, Q3 you're down. At all times, you are trying to protect your trading capital. So the best thing that I see traders do is they forego paying estimates and they take the underpayment penalty. They take the penalty because they would rather have that money to trade with. As you approach the end of the year, you got 2 months, 3 months left in the tax year. In that situation, you can reasonably project where you're gonna finish the year. That is when you start taking some off, you start paying your taxes. And as you cross the end of the year, you can cover that liability by January 15th, so that way nothing bad happens the following tax year. Now, in addition, if you're in a state with state income tax, you should consider paying before you're in. If you wanna take a itemized deduction for the tax that you're paying to the state that you live in. But if you don't live in a state with income tax, then this does not apply to you. Consider tax loss selling. So this is going to be on swing positions and long-term positions. So if you have significant tax liability realized on the year, you should consider selling some of your positions that are losers. So that way you can reduce your overall capital gains exposure. Now, also, you want to make sure that you don't repurchase the losing positions 31 days before or after year end, as this would negate the tax loss with the wash sale rules, right? So again, you take a loss December 1st, don't touch it again until January 2nd if you fall under the wash sale rules. Otherwise, that loss is gonna get pushed into the next tax year, and so you won't be able to recoup that until the next tax year. So you wanna be careful with that. All right, so if you are an active trader, you wanna assess your trader status, right? So if you qualified last year, you gotta qualify this year and next year, right? So every single year, you gotta make sure that you are maintaining trader status to maintain your business expense treatment and the ability to use mark to market, which I'll touch on here shortly. How you know you qualify as a trader, just run yourself through the behave test. I've got some content out there. I'll leave a link above on how to qualify for trader status, but the quick and dirty version is you need to behave, right? You got business expenses that are reasonable and necessary to a trader. You've got equipment used for trading. You spend at least 4 hours or more in the market. Your average holding period does not exceed 31 days. Your volume of trades comes out to about 720 per year, and that's each transaction, right? So that's on the buy and the sell. It's not the round trip trade. And the extent of your trading must be at least 75% of market days. So the equities market, if that's what you trade, 252 days on the year, 75% of that is 189. So make sure you beat the behave test, and you can assess that as we get into the end of the year. That's how you'll know if you qualify as a trader. We get many clients who tell us they're traders, and we look at the data, they don't qualify. So make sure that you are maintaining your trader status. Accelerate business write-offs. Now, this is a forward-looking event. If you know that you got some expenses that you're going to incur the following year and you want to reap the benefit of the write-off this year, you want to pay those expenses before the end of the year. For example, many of our clients pay their tax preparation fees upfront in 2021. That's the year we're in now. So that way they can write it off in 2021. If you wait until next year, guess what? It's a write-off in the next tax year. Other things, maybe you got subscription services and you're on an annual fee or whatever, you can write that stuff off now if you pay for it now. So if you plan on buying a new computer system, you want to upgrade your equipment, now is the time to buy it so that way you can get that write-off. There's a ton of things that you can write out, but just remember, you can accelerate business expenses to reduce your overall tax exposure. look out for wash sales. Get a handle on wash sales. Right now, there's not a whole lot of information out there on how to track real-time wash sales because your broker doesn't tell you that information. Remember, with the wash sale is a cumulative number, so it will never go down. As you trade throughout the year, it just goes up, 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 and up. Where it becomes a problem is if you have a wash sale deferral. So the broker is going to report all of your wash sales. So a quick primer, right? Let's just say you traded Tesla and you took a $10,000 loss, right? Maybe it's December 25th. You turn around and trade Tesla on December 26th. Well, on the 25th, that loss just got disallowed and it gets added to the new trade on December 26th. And let's just say on December 26th, you actually end up making money, you make 20K. Well, the net on that trade is going to be $10,000, right? You sit out of that for 31 days, you don't touch it again until January 27th. Same scenario. Let's just say you touch Tesla December 25th, you take a $10,000 loss, you trade it January 2nd. Well, guess what? As soon as you trade it on January 2nd, you just flagged a wash sale deferral. And in that situation, the loss is going to get pushed into the next tax year. So now your income is going to be $10,000 higher and you got a wash sale that's going to be moved to the next year, added to the cost basis of your Tesla trade next year. So you want to be very careful. This year, I do have a product that's going to be released sometime Q1 of 2022. And basically it's called Trader Fyles. And what this is going to do is it's going to help you make real-time decisions with your wash sale. So that way you will know at any given point if you have an open wash sale. And it's also going to help you calculate your trader related tax forms, right? So your capital gains, short-term, long-term, 8949, Schedule D, and Form 4797. But for all of our clients, we will be using that this year. And for anybody that's not a client of our firm, you will still be able to use that software. Like I said, keep a close watch on your potential wash sales. You can avoid these by selling these positions before you're in. Do not purchase substantially identical positions. IRS views substantial identical positions as both the stock and the option. So Apple shares, Apple options, those are substantially identical because they are the same in substance. The same thing, you want to watch out for permanent wash sales flagged in your IRA. So if you trade Apple in your taxable account, you trade Apple in your tax deferred account, guess what? You could flag a permanent wash sale, and that wash sale gets permanently disallowed and it is not carried to the cost basis of your next trade. Now, if you are a mark-to-market trader, you can go ahead and just close your ears because the wash sale does not apply to you. Your positions are mark-to-market as of the end of the tax year. Mark-to-market accounting, or Section 475. So if you don't have an election for the current tax year, you should consider making that move next year by following that with your tax return. You attach an election statement with your tax return on April 15th, notifying the IRS that 1, you qualify for trader status, 2, you are electing 475 for securities and options trades. What does mark-to-market do? 1, open positions are priced on the last trading day of the year. So if you have any open positions, whether they're in a gain position or a loss position, they automatically get marked to market as of the close, right? So if you have a position with unrealized gains, mark to market is going to treat that as if you sold that when the market closes on December 31st. You will pay short-term capital gains tax on it. Now, January 1st of the next year, your new basis will be that closing price of the next year. And then when you decide to either sell it, whatever, then your new sell date will be based on the next year because your positions get marked to market. So you want to make sure you're monitoring that so that way you will take those gains or losses at the end of the year. Like I said earlier, mark to market, you have no wash sales. This is where you want to be if you're going to be an active trader. You get ordinary gain loss treatment. So on the gain side, not subject to self-employment tax, you pay short-term, you pay ordinary income tax rates. On the loss side, if you finish the year in a loss position, guess what? You get to write off the entire loss amount against other sources of income, whether that's W-2 wages, you got another business, you got some form of income, you can write off your mark-to-market losses in full against those. Now, if you paid some tax on any of your other income, then you will get a refund of all the tax that you paid based on your loss. And then lastly, if your income isn't in a certain range, you get to use the qualified business income deduction. But a lot of our high earned incoming traders, if they're over the QBI threshold, then you won't be able to take it. So I just wanted to put that out there. Being a 475 trader, you do get the QBI deduction. If you trade under an entity, whether that's a single member LLC, a partnership, or an S Corp, you want to pay close attention here. Make sure your annual report is current with your state. Every single state has different requirements, but generally speaking, you usually have to file that annual report within 2 to 3 months after year end. And normally that annual report is just information, updating where the business business is located, if you added a partner, if you added or changed your registered agent. It's very much basic information that you want to maintain with the state. If you're doing business in another state, let's say your business is registered in Delaware and you live in Florida and you're doing business in Delaware, then you would need to register that business as a foreign corporation. So if you are in that situation, make sure you have the foreign corporation designation up to date within your state. Now, if you ceased operations and you canceled your LLC during the year, then you want to make sure you file the proper dissolution paperwork with your state. If any changes have been made this past year to the information in your original articles of incorporation, you're required to file an amendment with the state of formation. If you're a first-year S corporation, you've got 75 days from when you form that S corp to file the S corp election with the IRS. The IRS can take up to 90 days. I've seen it longer, even 5-6 months, to basically confirm your S corp election. You want to monitor your mail because they will send the confirmation to the address you registered the business, and you want to attach that with your first year tax return with your S corporation. Now, payroll compliance, this is for our S corp clients. You must pay compensation and execute officer payroll by December 31st. You want to lock in your W-2 wages. You want to identify how much you're going to pay yourself, how much you're going to move to your retirement plans, and if you need to deduct medical insurance. If you currently have an LLC, but you missed out on benefit plan deduction for 2021, then as we get into next year, you want to consider making that S corp election. By making that S corp election, this will allow you to pay yourself wages to take advantage of those benefit plan contributions and also those health insurance deductions. Because without it, as a trader, you only have capital gains, you don't have earned income, you can't leverage those two deductions. Now, if you're on the fence about starting an entity, then now would be a good time to consider that January 1st of a fresh year or starting a brand new business. What we're gonna do is we're gonna shift focus. We're gonna talk about some of the tax law changes that you can expect this year. Advanced child tax credit payments of $3,000 issued in July must be factored in your 2021 return. Very similar of how the stimulus checks worked last year. If you were a taxpayer that received a stimulus check, you had to include that with your tax return. Maximum dependent care for 2021 is increased for taxpayers with AGI of $125,000 or less to $4,000 for one child, $8,000 up to 2 or more children. And this is up from $600 and $1,200 respectively. Now, the third round of the economic impact payments begin March 21st, max of 1,400 plus dependents. So if you receive less, there is a potential to claim a credit on the 2021 tax return. But if your income went up, highly unlikely you're going to be able to do that. More to follow on that. Now, the extension of the $300 deduction for charitable deductions if you claim the standard deduction. So you remember, you claim the standard deduction if your itemized deductions are below. You take the higher of the two. Now, if you take the standard deduction, Uncle Sam is going to allow you to write off $300 of charity-related contributions. Gross income will not include any amount equal to the forgiven amount of a Paycheck Protection Program loan, and that expenses paid with basically PP loans are fully deductible. Now, this is huge. Most trading businesses, matter of fact, I don't think I've seen any trading businesses take a PPP loan. This is going to be for the small business owners. You've got some type of business on the side where you needed to get a PPP loan. If you got full forgiveness and you paid classified expenses, those are completely forgivable and you include those on your return, and you don't have to include the PPP loan as income on your tax return. I think this is huge. Thank Uncle Sam for that. They are also extending the ability to deduct 100% of certain business meals. So if the business meal is a qualified business meal, you get to deduct 100% of that. Historically, that has been a 50% write-off. Now you get to take the whole 100%. Adjustments for inflation. Standard deduction are increasing. Married, filing joint is $25,100. Single is $12,550, and head of household is $18,800. IRA contributions remain the same, but the phase-out levels for taking the deduction for these contributions occur between $66,000 to $76K if you're single, $105 to $125 if you're married filing joint. Phase-outs do not apply if either the taxpayer nor the spouse has a workplace retirement. Now, I will say, if you have strictly capital gains, you don't have earned income. If you don't have earned income, you can't contribute to the retirement plans, whether that's an IRA or SEP or solo 401k. You need earned income. As a trader, if you want to do this, I'm gonna say it one more time, you need an S corp election with earned income. The exclusion of $10,200 of unemployment compensation will apply again this year. So if you have household income of less than $150,000, you can then claim that $10,200 tax-free. You don't pay any tax on it. All right, guys, so this is not an all-inclusive list of every single thing that's going on. What I tried to do is I tried to be a sniper, and I tried to cherry pick tax planning items as we get into into the end of the year, and also tax law or tax code changes that you can expect in 2021. Now, if you found value in today's video, don't forget to smash that like button. Don't forget to smash that subscribe button. And I sincerely wish you guys the best of luck as we finish out this trading year, this trading journey, and we get ready to pay Uncle Sam his cut. Have a good one.